Okay, Grandad, so on the last podcast, we discussed everything a beginner investor needs to know in relation to dividends. And towards the end of the podcast, we also briefly touched on defensive and cyclical stocks. And we did say we'd dive into it in more detail in this podcast. So let's continue on from where we left off. And I'm going to hand it over to you now, Grandad.
Okay, so we're going to start and look at defensive stocks. Defensive stocks are stocks whose share prices are not hugely affected by changes in the economic cycle, going from economic growth down to recession and back again to growth. The classic defensive stock, if one wants to think of one, is the pharmaceutical industry, the people that provide medications. Because if you're on, say, medication, it doesn't matter whether the economy is high or the economy is low. You have to have the medication. So Granny needs her medication, as I said before, in good times and in bad. So pharmaceutical companies are a classic company which is really not as impacted by the economic cycle as other types of companies. So, for example, one of the ones that I bought was Pfizer. It's a classic pharma. And what happened was it developed COVID-19 vaccines. So it made huge money during that time. So the share price shot up and the dividends shot up because everybody could see the earnings of Pfizer shooting up. Then the hoo-ha over COVID has declined significantly in the last year or two, with the result that Pfizer's stock price has fallen and fallen significantly. The European pharma sector, for example, grew by 50% in the last 10 years, which is, if you like, a 5% increase every year. But when Pfizer, being one of the biggest pharma companies in the world, lost this extra bit of business, well, then its share price fell. And when its share price fell, its dividends yield went up because it was still paying the same dividends, but its market price of its share had come down. So I was able to buy Pfizer at 5.73%. In the last 3 or 4 months, I bought it. A dividend of 5.73%. It wouldn't normally pay you 5.73%. Now, pharmaceutical companies and big pharmaceutical companies with a lot of experience are constantly in the situation where they find new drugs. The drugs have patent protection for 20 years. Nobody else can make this drug. But after the 20 years is up, everybody can jump in on the drug and make it. So pharma companies are constantly having to find new drugs. That's the business they're in. So I happen to believe that Pfizer will find and discover new drugs. Now, they might have to buy small little companies that have the new ideas and the new drugs, or they might be able to do it from within their own laboratories. But find new drugs, they will. And therefore, I'm very happy to lock into Pfizer at 5.73%. And also, I believe that, over time, the Pfizer share price will go back to normal, as all pharmaceutical share company prices do. So that's one example of a defensive stock. Another example of a defensive stock is the utilities industry. You might describe that as the electric company or the gas company or any company that's providing services like that to households and businesses are called utility companies. The utilities, you have to pay for your electricity bill, irrespective of whether the economy is booming or the economy is stuttering. So therefore, utility companies have the same characteristics as pharmaceutical companies in that they're not as impacted by movements up and down in the economy. So I just want to get a bit of paper down here. The wind blew it away from me because I have the window open. Okay, an example of a utility company share that I bought is Enbridge. It's a Canadian utility company. Now, it's not an electric company or a gas company, but it provides the oil pipelines for oil companies. And therefore, they have to spend big money putting in new pipelines all around the United States and Canada. They're one of the biggest pipeline companies in that part of the world. So therefore, they need to have a significant amount of money, of extra capital, to invest in oil pipelines, the new ones that are required, and if you like, getting rid of the older ones that are no longer required, and maintaining the ones that are there. So they're a big infrastructure company. So Enbridge has the characteristics of a utility company because it's the utility company's oil that they're and gas that they're actually shipping around the place. And I bought Enbridge, and it currently has a dividend yield, which I believe of 6.93%.
That's good.
And when you think about it, okay, getting in and getting a utility company to pay you 6.93%, and the share price, it may not go up very high, it go up at 2 or 3 or 4% per annum, but it won't fall very much either. So you're locking yourself into 7% on a dividend yield and say 3% on share price over time per annum, and that gives you a kind of a 10% return on Enbridge. So those are examples.
Can I ask you a quick question, Grandad?
Yeah.
So, as defensive shares don't typically operate within the current economic cycle, okay, does that mean that they would, in general, have a lower beta than cyclical shares?
Yes, they would have a lower beta because they're not as volatile. The share price isn't as volatile. But if the share price falls, the dividends are very, very predictable. So if the share price falls and you can latch in at 6% or 7% into defensive stocks, you'll have those forever. And in fact, they'll increase those dividends, a little bit each year. So your 7% could end up at 8 or 9% before you're finished with these. So they're a very good share, and they're a share that really you should be looking at for all the time, not just in economic recession, but in an economic growth as well, because all you're looking to see is what is the dividend yield, and are they paying out more than 50% of their profits? And if they're not, jump in, as I did with those two particular stocks.
Yeah, they're sort of like operating on their own cycle.
Yes, they are. And you see, the oil companies and the gas companies, they need pipelines.
Yeah.
And when they find a new or develop a new mine, someone has to build a pipeline from that mine to the various households and businesses across the United States and Canada. So they're constantly finding new oil and gas. So the Enbridges of this world are constantly building pipelines and closing down pipelines and maintaining pipelines.
Correct me if I'm wrong, Grandad, right? But is mining companies not considered a cyclical share because economies don't buy natural resources during downturns?
That's correct. That's correct. But the pipelines.
But the pipelines one are okay.
No, the pipelines are still there.
Yeah.
In other words, even if you're only selling half the oil, it still has to go through that pipeline. You can't close half the pipeline down. So the pipelines are still there.
So how are those two? I get you. Yeah. So how are those two companies that you invested in doing at the minute?
Well, first of all, I'm ahead on both of them. But only marginally. I'm not investing in those to make a huge amount on the share price. I'm investing in those to make a huge amount on the dividends.
Yeah.
Okay.
Yeah.
But I am ahead on both of them. Now, there are other companies I bought, which we'll discuss later, where I'm not ahead, but they're not defensive stocks at the moment.
Okay, so let's just do a little wrap up on defensive stocks. So defensive stocks are shares which aren't as volatile, so they would typically have a lower beta, and because of that, they tend to have higher dividend yields, typically, and they operate within their own cycle, which is kind of separate to the economic cycle. And in the example you gave is Pfizer, uh, and Granny needs to buy her medication during economic booms and during recessions.
That's Pfizer, and then Enbridge was the other one.
And Enbridge, yes. So oil companies need
Enbridge
oil
isn't
pipes.
actually, no, Enbridge isn't actually a utility company,
Yeah.
but the utility companies have a consistent and constant requirement from Enbridge, whether
Yeah.
it's good times or bad times. So it has the characteristics of a defensive stock.
Okay, so then what's a cyclical stock, Grandad?
Well, a cyclical stock is a stock which booms when the economy is booming, a stock price which falls when the economy is falling. So I'm going to give you an example of you and your car. If you have a job and you have a car, and the car is now 5 or 6 years old and you're thinking of maybe of changing it. But if the economic bad times are there, and you know that there's a possibility that some people will be made redundant in your company because your company is not doing as well as it did because of the bad times, right? Would you change your car,
No.
or would you hold on to your spare cash until the good times come?
Hold on to the spare cash, I'd say.
Yes. So what happens is that when bad times come, people become very cautious. They spend less. They save more. And as a result of that, company earnings are reduced because instead of, your local pub selling you 7 pints of Guinness a week, sorry, they'll sell you 2 pints of Guinness a week.
Mm-hmm.
Or, instead of your car company getting you to buy a new car, they won't be able to sell you a new car. So the result of all of that is that company earnings will fall because sales fall. And therefore, that's due to the consumer or to the business that's been very careful. So that's the question, right, of what is a cyclical stock. Okay. So the question then is, all right, what are examples of cyclical stocks? Well, obviously, automobile or car companies are examples of cyclical stocks. Mining companies, which provide the commodities to businesses to manufacture things, will sell more to those businesses when the business's manufacturing takes off again in the good times. So that's another example of them. So you have to be looking at the particular industries that you're investing in to establish whether they're cyclical industries, which do well in the good times but don't do so well in the bad times, or whether they're defensive industries. So I suppose what I'd be saying to you is, I have, for example, as a classic cyclical stock, I bought one recently called Volkswagen, which we've discussed. Volkswagen peaked on the 4th of April at a price of 128.50, and then it started to fall. And I said, okay. So what did I do? I went in when the share was 123. Okay, thinking I was a very clever boy. The latest share price for Volkswagen is 95.
Oh, Jesus.
Okay. So it is down by 16%, or sorry, down by a significant percentage. I don't have the percent here, I think. But the problem I have is, right, that I'm now locked in at a cyclical stock, but I went in too quickly. And that's the danger you have, that you don't actually get it right. However, I still have Volkswagen. I have sold some of my Volkswagen and taken a loss because it's always useful for me to sell some loss-making shares every year because I make profits on the other shares. And if I don't sell some, I'll be paying tax on my capital gains. So I manage I have an exemption on capital gains as a married couple of 2,570, that is in Ireland, gains a year. So if I go over the 2,570 capital gains, I have to pay tax. So if I throw in a few losses and bring it down below the 2,570, I don't pay taxes. So I said to myself, well, I had 10,000 in Volkswagen. Let's take 5 of that out. Take my losses, see my capital gains tax reduce, and cry in my soup. So that's what I have done with Volkswagen.
A strategic loss. You planned that all along, Grandad. Pretend you planned it all along.
Yeah, but I haven't, if you like, I haven't sold all of the Volkswagen because I believe Volkswagen will come back.
Yeah.
Because, we're heading into a recession. But when the boom times come back, things will improve.
Yeah.
So that's Volkswagen. The other one I bought was a mining company called Rio Tinto. You'll be glad to know I'm up on my Rio Tinto mining shares. The Volkswagen dividend is actually over 9%. That was so I'm in at 9% on the Volkswagen share.
Yeah.
But I've sold half of those now. But with the money I sold, I went into another share that delivers 9%. Okay.
Yeah.
But which I feel has less risk than Volkswagen. Okay. With regard to Rio Tinto, I'm getting a yield at the moment of 6.97%, which is very good yield on a mining stock. And when the good times boom again, Rio Tinto share price will go up. So it's unlikely that they're going to cut that dividend. So there's are two examples of shares I went into on the basis that I was going in when the economy is stuttering and faltering.
Yeah.
And one has worked out and the other one hasn't worked out. Now, I've a load of cyclical stocks, but they're just give you an examples of how you can get it right and how you can get it wrong. One thing I should also mention, and I mention it in the book, there's a very famous US economist called Paul Samuel, and he is quoted as saying that the stock market has predicted 9 of the last 5 recessions. What do you think that means?
The stock market has predicted 9 of the 5 last recessions. I would say, Grandad, it probably means that as these cyclical shares start to perform poorly, that's probably the indication that the economic time is turning, maybe?
No, what it indicates is that the stock market is more likely to panic than reality. They've predicted 9 recessions when there was only 5. Okay. So the big question is...
Oh, it predicted 9 when there was 5. Okay, sorry. Yeah. I thought you meant it had predicted 5 out of the 9. Okay, sorry.
No, it predicted 9 when there was 5. It's a very clever quote, isn't it?
Yeah, that's good. Yeah.
It's showing how panic grips the markets.
Yeah.
Okay. So the question really is, how can we predict recession? And how can we predict boom?
Okay.
Now, I need to talk to you about 2 things: lagging indicators and leading indicators. Now, a classic lagging indicator is unemployment. So what actually happens is you're working in a particular job and suddenly the sales are not as strong as they were. Okay. And suddenly the earnings of the company start to fall and cash becomes tight. What would the company do in those circumstances, Adam?
Well, I think there's a lot of steps before they start laying off people, but I think they would lay off people is what you're trying to get at, is it?
Yeah. And what
Yeah.
I'm trying to say to you is that would be the last thing they would do.
Yeah.
So when unemployment goes up, we all know there's a recession,
Mm.
okay? Because the recession has preceded the unemployment. Because people are holding on to their staff. Oh, we don't want to let them go. Well, we need these. We could need them next week. So they hold on to the staff, but eventually they're forced to let them go. So unemployment is a lagging indicator. It's 100% accurate in telling you when there is a recession. It doesn't tell you when there will be a recession. It tells you when there was a recession. It's a lagging indicator. So if you want to predict the turn in the market, you have to find leading indicators. Now, there's many leading indicators. I'm just going to give you an example of them. Economic sentiment. So what happens is you have polling companies that go around to various businesses and government departments and central bankers and so on and so forth, and they take the measure of economic sentiment, which is basically saying, are things going to get better or are things going to get worse? And they've been doing this for 50, 60 years that I'm aware of. May even have been doing it longer. And it's done in nearly every country in the world. So there'll be an Irish economic sentiment index. There'll be a US economic sentiment index. There'll be a UK economic, and so on. And they measure it. They have ways now, the statisticians, of figuring out just how much heat you think is coming in the economy or how much cold is coming in the economy. And they measure it. And they have an index of 0 to 100. If the index is 50 or above, that's telling people that the sentiment is that the economy is in a growth pattern. Okay?
50 and above. Okay.
50 and above. The next one I'm going to, and if it's below, of course, it's telling you that you're heading for disaster. Okay. Now, it could be 47 or 53. It's never kind of, 10 and 90. It hovers around the 50.
Okay.
Sort of between 45 and 50, and between 50 and 55 would be kind of normal, right? But when it's heading up towards the 55, yippee. And when it's heading down towards the 45, lock the door and don't let anybody in near you, okay? So that's the economic sentiment. There's another one then called the purchasing manager's intentions. So that's where polling companies go around to people who purchase things for businesses. And they say, tell me, are you going to purchase more this month than you did last month? Are you going to purchase less this month than you did last month? Because remember, the purchasing manager has to make sure there's enough stock in the shop. Okay? So if he purchases too little, then the shop runs out of stock. If he purchases too much, then he has a whole lot of unused stock. So he's trying to figure out what the sales will be in the shop next month. And then he orders at the end of this month to have that's there. Okay. So the purchasing manager's index is another leading indicator because they're looking forward. They're purchasing for next month and the month after and the month after, right? So it's a leading indicator. And believe it or not, if it's 50 or above, it's good news. And if it's below 50, it's bad news.
Okay.
And that's done for most countries in the world. And it's done, for example, for the EU, and it's done in all the different states in the US, and it's done for the US as a whole, and so on, right? I'll give you one last example, which is consumer sentiment. So they'll stop you, right, when you're rushing to get your lunch or something like that. Somebody will stop you and say, tell me, how do you feel about things? Are they going to be better or are they going to be worse? You, the consumer, right? So that has an index as well. So there's loads of different of these types of indices, and they move the markets, obviously, because they come out. For example, the European and UK all come out with this index around the same time, and then the markets say, "Oh, I don't think I like Volkswagen because the index is now down, and people will be buying less cars." Or I think I'll switch a bit out of the cyclical stocks and put a bit more into defensive because I think the cyclical stocks are going to fall. So that's economic indicators. And that's what people use. Now, that just because you use those indicators doesn't mean you're right. But the probability is you're right 80% of the time. And that's not bad. If you're right 80% of the time, you're wrong 20% of the time, but then 80% of your decisions should be right, and only 20% of your decisions should be wrong.
So, Grandad, let's say the economic sentiment came out and it was slightly below 50, and then the purchasing manager's intentions came out and it was slightly below 50. Typically speaking, cyclical stocks would fall and defensive stocks would rise, or...
Yes, you would find some people saying, "You know what? The Volkswagen share peaked in April. It's now going to fall. I'll sell now and cash in and get the maximum bang for my buck."
Yeah.
And then when it goes down, I'll buy now because it's going to go one way up. So I'll gain in the future.
And I suppose where people could access this information is by a quick Google search and it'll come up for the
Oh, yeah. And, all the business channels,
Yeah.
quite a lot of news channels talk about economic sentiment, and they talk about consumer sentiment, and they talk about purchasing PMI, they call the purchasing managers' intentions,
And how frequent do these come out? Quarterly, annually?
Monthly.
Okay.
I think monthly. Now, it may be different in different countries, but I think it's usually monthly that comes out,
And one thing I remember about unemployment from the economics course I did throughout the year there was that a lot of the time you'll hear the phrase full employment, even though unemployment might be like 3.5%, 4%, but anything under 5% unemployment is considered full employment. Is that correct?
Yes.
Okay.
Now, it's different in different countries.
All right, okay.
But the facts of the matter are everybody doesn't always work.
Yeah.
You're going to have 4 or 5% of people who, for whatever personal reasons, they're not going to work.
Yeah.
So once you get down to an unemployment rate of 4 or 5%, wages are tight because everybody is now working.
Yeah.
So if you want more people, it's hard to get them.
I remember seeing recently as well that South Africa had elections recently, maybe like last month or 2 months ago or something like that.
Yeah.
And at the time of their elections, their unemployment was 33%, which is incredibly high. That's 1 in every 3 people unemployed, which is insane.
Yes.
So, yeah.
They're
doing pretty well here.
But in many of those African type countries, they don't have very good social security. So in other words, in many cases, you get very little from the state if you're unemployed.
And the infrastructure is poor and stuff like that as well.
Yeah, so effectively, it's a sign of a civilized country, in my view, when they look after the people who are less fortunate. Now, the Republican Party in the United States wouldn't agree with that, and the Tory Party in England wouldn't agree with it. But in fact, most people would want to give a helping hand to people who are temporarily out of work. There is the worry that some people are out of work, and are gaming the system. Yeah. And of course, that is true. Yeah. Any system that you have where there's free handouts, some people will get them unfairly, but the vast majority of people get them fairly. And there is no way of making sure that everybody can get them fairly. So you have to suck it up and take it, baby.
Okay, well, let's do a little recap then of what we just discussed within this podcast. So the first thing we looked at was defensive shares, which are shares that kind of operate within shares that operate within their own cycle that's separate from the economic cycle. So they like Pfizer, for example, where they produce medication and Granny needs her medication in recessions and in booms. And they typically pay higher dividend yields and have lower betas, so they're not as volatile
Yeah.
towards the market. The next thing we looked at was cyclical shares. And cyclical shares operate within the current economic cycle, so they do well during booms and then poorly during recessions. And one thing that I was just thinking about when you were saying that, Grandad, that I would like to mention is that it's sectored. So typically things like mining, as you said, that produce commodities, so that's highly cyclical. But also, I was thinking that maybe someone at home might be thinking, okay, well, I use Google during economic recessions and during booms, but Google do poorly during recessions. But that's because the revenue that's generated, or how Google generates the revenue, is through businesses advertising, and then businesses do poorly. So it's just, I think I'm trying to make the point that it's important for us beginners to think about where the revenue is being generated from, because that will determine whether it's cyclical or defensive. Am I right?
Yeah. And there is one industrial sector which is split 50-50, kind of.
Okay.
In other words, one industrial sector has cyclical stocks and it also has defensive stocks.
But let me guess. Insurance?
No.
No.
Consumer companies.
Oh, okay.
Because you see, if you go into your supermarket for food, okay, you have to have food in good times and in bad times. So all your supermarkets that sell mainly food are all defensive. They're called consumer staples. No, it's the staple thing that consumers need. That's consumer spending is defensive. Consumer discretionary, like I'd like a new blazer, with a stripe down the back, That's consumer discretionary. That does well when consumers have a lot of money, and doesn't do so well when consumers don't have a lot of money. Okay. So consumer staples are another defensive stock, and consumer discretionary is a cyclical stock.
Okay, and then cyclical stocks tend to pay less in dividends, but not always the case.
They pay a reasonable dividend, but they never dividends isn't their main business. Their main business is waiting for the recession and battening down the hatches, and then when they see the turn coming, expanding. So in a recessionary time, they have to be careful that they're not locked into very high dividends, because they won't have the income for that. So they tend to have dividends which are slightly less than the defensive dividends. But that doesn't always apply, of course. You'll always have the exceptions.
And then the example you gave of a cyclical share was Volkswagen. And so then we move into the economic indicators.
And Rio
Tinto, yeah.
The mining company.
And then when we move into the economic indicators, we looked at economic sentiment. And anything over 50 is good. Anything under 50 is bad.
That applies to them all, to all the indices,
And then the next one is purchasing manager intentions. Yeah. And again, that's over 50 is good, under 50 is bad. And then lastly, we looked at consumer index, consumer sentiment.
Consumer sentiment, yeah.
And that's an indication
the man and woman on the street is also interviewed. Like the economic sentiment would be interviewed by people who kind of understand economics, I suppose. The purchasing manager index they're all in businesses, but the consumer is the man and woman on the street. What do you think, guys? Because they actually they're another contributor to the excitement or to the disaster of a business.
Okay, well, I think we'll finish it up there, Grandad. That was a good one.
All right, okay.
Yeah. I also don't actually do any outros in the previous podcast, okay? So I want to do an outro here. If you like this podcast, make sure you like it, you share it with your friends. Hopefully you gain some kind of value from it. Also, go follow us on the social medias as well. That's at the Investment Hound. We're out on Instagram and TikTok. And you can listen to this podcast on Spotify if you're not listening to it on Spotify, and also YouTube as well. And thanks very much.
Can I say to you, Adam?
Yeah.
Okay. And you don't know yet, but the next podcast is going to be a huge surprise. It's going to be quite different to any other podcast.
Okay.
But
Happy
I'm
days.
not going to tell you what it is until we're off air.
Okay. Happy days. Well, we're looking forward to it. So, all right.